Keen is a business that my dad founded in 1982. Began my career as an attorney, big firm legal practice, litigation practice on the West Coast. Left that in 1988, so now for 35 years, which is an incomprehensible amount of time, I have been doing this. Our company is a real estate advisory firm that provides brokerage, investment banking, and workout restructuring services in the context of bankruptcies, workouts, receiverships, what we call special situations. So we find ourselves in large corporate bankruptcies. We find ourselves in small wind downs of businesses. We're property type agnostic. We work across the United States, across North America. We're geography agnostic. And recent projects range, or some big client names include Sun Edison, when they went into bankruptcy, where we were their real estate advisor. When Toys R Us was in bankruptcy, we were one of their real estate advisors. We just sold a golf resort in West Palm Beach in a bankruptcy called Banyan K. We sold during COVID a hotel in Beverly Hills, the Hermitage Beverly Hills Hotel. Maybe you've stayed there. There was a vacant hotel with a Saudi royal family on the top floor who got stranded in Beverly Hills. And we sold that for a record price. So anyway, we come across a lot of interesting situations. And I'm talking about the great real estate repricing, which is Marty's phrase, but I like that phrase. Let me see how I turn pages here. Page down. Yeah.
There you
go. Okay. So the great real estate repricing. Sometimes these conversations are theoretical. And this is not a theoretical conversation. And I think this is a conversation about asset prices in general. I started noticing, I've had the good fortune of having lived through a variety of cycles, starting with the S&L crisis and going from there. And it always was surprising to me, I'd say shocking to me, how you would have an asset that was purchased for this price by a big name investment group, backed by LPs who are very smart people, backed by leading banks, and they bought it for 100, and now it just sold for 50. How could that be, right? How could that be? Why isn't there intrinsic value? How did they miss that? And a little over a year ago, I started noticing in the real estate press that happening, that assets were selling for dramatically less than they were purchased for. So before Marty and Peter, Pete, spoke, I had scrolling on the screen. I don't know if you noticed it, but I have been finding these articles and posting them on my LinkedIn account since about March of last year. And I excerpted those, put them into a PowerPoint, and those were scrolling through. And it's just a series of examples, and I have 3 of them up here on the screen. So the March 9th example from 2022 is the Sheraton Hotel on 7th Avenue. It sold, I got some shit up here. Okay, it sold for $365 million. In 2006, it was purchased for $738 million. Oh. So that's not the right direction. Similarly, right? It's just so obvious.
It depends on if you're the buyer or the seller. Right?
It depends on where you are in that transaction. Later in that month, Blackstone handed the keys to 1740 Broadway back to its lender. 1740 Broadway, not the most awesome location in New York City, but a very serious and respectable office building in a decent location. The debt was $308 million. They had bought this property for $605 million in 2014. In June, it's reported CMBS investors took 100% loss on $107 million of debt on the One AT&T Center in St. Louis. A loan backed by the Hilton Galleria experienced an 84% loss. a loan backed by the shops at Willow Bend, another mall, experienced a 78% loss. And I mean, this story just goes on and on. So if you did not see that deck that was running beforehand and would like to get a copy of it, give me your card. I'll email it to you, and I can do the same thing with this presentation. So I've just got a few charts to run through here. I kind of hate speaking to charts, but Green Street, one of the leading real estate analytical firms, you're charting in that black line, the drop in value from a high point. The common talk is commercial real estate prices are down roughly 30%. This looks at office, and perhaps it's a little hard to see. The dotted line is kind of as of today. So to the right of that dotted vertical line is the forecast. And at the top on office prices, you see sales volumes. And we'll see this for all the different property types. Sales volumes have dropped dramatically, and that has important implications from a valuation perspective. Yeah.
So this top slide is average office in the United States. It's not any one city.
Correct.
Okay.
Correct. And there's lots and lots of ways to break this down. Right, you could break it down by city. The bottom slide breaks it down by 3-star versus 4 or 5-star properties. That's a CoStar. CoStar is another data real estate data firm. The green line is United States overall. So on that top chart, price per square foot is the blue line, and you could see where it was, let's say in 2022, and just dropping, and projected to drop just dramatically. Market cap rates are at the bottom. A cap rate is your yield, your anticipated yield return, and as the cap rate goes up, the value of the property goes down. It's an inverse relationship, and you can see how starting in kind of 2021 into 2022. Cap rates have gone up and are forecast to go up dramatically.
And so the thesis is that as long as interest rates remain high, this is the forecast. Or does this include a possible drop in interest rates?
So I don't know how CoStar forecasts this and what their anticipation of interest rates are. But I think that's a great question. There's a lot that goes into this, and we're going to talk about that as we get through this presentation. Here's a stock graph of Vornado, large premier office building owner in New York City. Steve Roth is legendary for his prowess in the real estate world, and you can see where the stock chart is. Similarly, SL Green, also maybe they're the largest New York City office building owner, right? Their stock has just fallen, can't fall all that much more. Jumping to multifamily. Multifamily in general has been the darling of the real estate. And let me just back up and say one more thing about office. One of the things that strikes me about what's happened so dramatically to the office market is the fact, it's almost, if you think about the banks that failed, a lot of why they failed is they were holding treasuries. My God, holding treasuries, what an outrageous thing. Right? Treasuries are the safest thing you can hold. Obviously, they didn't hedge against inflation risk, but it's the same kind of topic with office buildings. This was the gold standard of investment for real estate investor, to old trophy office buildings, and it's just changed so dramatically in the course of the past 18 months, 24 months. Really shocking. So a lot less sexy multifamily. Multifamily prices, I think, have held up a little bit better. But notice in the top chart, the yellow bars, how transaction values have dropped. Notice in the bottom chart, cap rates, they hit a low, which means values were high, and cap rates have been going up. Retail, right? Pretty much the same story, right? In the top graph, transaction volumes dropping dramatically. Price per square foot has stayed pretty high, but is forecast to drop dramatically. The cap rates have stayed good, low is good, but are forecast to go up. Hospitality, we're not going to get into it here. Hospitality is a little bit of a tale of two cities. Resort kind of properties have done very well. Urban business traveler properties have suffered.
I just have a quick question on hospitality
Yeah.
resorts. What about domestic resorts versus foreign, like Caribbean resorts, things like that? Any thoughts or any?
I don't have any particular knowledge about that. Transaction volumes have dropped, not as dramatically. There's been a slower rise in the price per room, the blue line up top, and that's expected to drop. Market cap rates have been relatively stable, but trending up and are expected to go up even more. And industrial has been kind of a darling. Industrial being distribution centers. Obviously, the Amazon effect has been dramatic since COVID. But again, the yellow bar is up top. Transaction volumes are down. Price per square foot has been pretty good and is actually expected to improve. Industrial has been pretty strong. So why has this been happening? So we're going to talk through all of these different, I think, factors, characteristics of the market: rising interest rates, inflation, rising cap rates, meaning rising yield expectations, tightening access to credit, transaction volume down, which we've pointed out in prior slides, and debt maturity crisis. So rising interest rates. Obviously, when interest rates rise, your debt becomes more expensive. So a lot of commercial real estate debt is variable rate, and those investors have been hit extremely hard. For people who have fixed rate debt or have locked in kind of caps, as those mature, they've got to refinance, and the refinancing costs are dramatically different. So here, here's LIBOR. Everybody here kind of knows this, but when you look at it in a chart, when I saw it on a chart, it really is pretty striking. You can see how it's close to zero. We all knew that it was close to zero. Now, LIBOR SOFR is over 5%. And if you think that you're paying real estate maybe 200 basis points over LIBOR, so maybe during COVID, you're buying properties, you're refinancing at 2.5% or something like that, and now it's going to be 5.5 plus 2.5. You're up to 7.5, 8%. So those costs are dramatically changed. Looking at a graph of prime, I mean, it's pretty much the same, different numbers, but the same impact. Inflation. I did not include a chart for inflation. We all know what's going on with inflation, but the import from a real estate perspective is you're evaluating for valuation purposes. You're looking at the real estate equivalent of EBITDA, which is NOI, net operating income. And if operating expenses are going up, your EBITDA or NOI is going down. Rising cap rates. So I have a pretty simple quote here. Rapid interest rate hikes by central banks have increased the returns on risk-free government bonds. We all know that. So commercial real estate investors demand more yield to justify holding such an illiquid asset. Right? That's what's going on. Investors are expecting higher returns, and with net operating income fixed and perhaps going down because of inflation, cap rates are going up, so valuation is going down. So there's lots of talk about. We can talk about the office market in particular, and people downsizing their space, and people not coming back to the office, and work from home, and are people going to come back to offices? But from my perspective, today you can put that aside. That's going to play out. People have long-term leases. Pulcinelli, I don't know when their lease is up for this space, but they probably signed a 10-year lease. Might be coming up next year, might not be coming up for 9 more years. that almost doesn't matter in the light of how cap rates have risen. The rise of cap rates has just killed value in commercial properties. The rise in interest rates and the rise in cap rates. So here's an interesting chart. So what it shows on the vertical axis on the left-hand side is, okay, let's say net operating income goes down by a certain percentage. Goes down, the first line, it goes down by 2%, or it goes down by 4%. And across the top, it has variable interest rates, variable cap rates. And you can see the impact on value based upon the combination of those changes. So if you just simply said that because of inflation for the past 2 years, on the vertical axis, let's just say net operating income has gone down 10%. And if the cap rate remained the same, let's say the property was purchased at a 5.5 cap, and the property that remained the same, the value would have gone down 10%. But given rising cap rates, because investors' expectations have changed, and you said, that 5.5 has jumped up to 6.3. You have a 22% diminution in value. That's huge. And the way this chart is set up, it's that horizontal line that runs down is meant to kind of figure out where do you capture basically like a 22% change in value. So in addition, what's happening to the mortgage market is there's an extreme tightening in lending. People who are looking to refinance are having a very hard time refinancing. You talk to property owners who need to refinance, they're going to banks they've talked to in the past, they're going out, they're getting quotes, they're not getting quotes. There was a recent piece about, I think it was Hines, which is a major property owner who put out 40 term sheets for a refinancing proposal and got back 0 response. So lenders aren't lending. I've got a variety of quotes here. I mean, there's a lot of demand, and we're going to get to what that demand is because there's a lot of debt maturing. But at this point, we're in a pretty troubled situation. I'll just read the top quote for those of you who can't see her. Higher borrowing costs have pummeled the commercial real estate industry, driving prices lower and causing some owners to choose to default. Much of the potential distress is tied to buildings that need a refinancing at a time when lenders are tightening credit following the collapse of several regional banks. The second quote just talks about regulatory scrutiny. So in this age of tightening credit, one of the reasons is because the regulators are all over the lenders. And the lenders are just uptight about putting out money with the risk of a lender criticizing and categorizing those loans. Transaction volumes are down. And we saw that in the prior chart. And really, it's about bid-ask spreads. Prices during COVID skyrocketed, given the cheap money and given the quantity of money. Excuse me.
We've got about 15 minutes.
All right, we're gonna make it, and we've had time for questions.
We have a lot of questions.
So prices went up dramatically during we'll call it the pandemic, during the pandemic boom. You've got this bid-ask spread where sellers still think their properties are worth what they were worth, and buyers say no, we're not paying those prices, and that's holding up transactions. What does transact are the properties that kind of have to transact because the seller has to sell, because maybe the debt's maturing, they can't refinance, maybe there's a drop of equity, maybe it's going to be a short sale. It's not going to cover all of the debt, but the banks have agreed to a short sale, and those are what's transacting. So what that ends up doing is creating this like vicious cycle that the property that does transact, take that early example from page 1 about the Sheridan, which was purchased for 700 something million years ago, now sold for 300 something million. Well, think of what happens on an appraisal when the appraiser goes out to appraise the next hotel. Room values just chopped in half. So the comparable sales that are being used in appraisals are just going down. And when you go out to refinance and you get an appraisal, it doesn't look good, even if nothing has changed with your property. So you kind of get that vicious feedback loop.
And it also says something for the owners, because a lot of these guys are large asset managers who are giving back these assets or selling them, and it ripples through their portfolio as well. I mean,
right. Blackstone and Brookfield have been in the news a lot over the course of the past year with troubled assets, and each of their troubled assets creates a comp for the rest of their assets. We've seen this for different industries, but again, this is compiled commercial property deal values, have dropped dramatically since that high point in early 2022. The debt maturity crisis. I have a quote here from me. I'm so happy to have this quote.
oh my gosh.
The apocalypse, and it's, I don't like to use words like apocalypse, but the reporter asked me the question and planted the word apocalypse, and I just like picked up on it, and she caught me. The apocalypse that's facing commercial real estate at this moment is all about interest rate and debt maturities. Just what I said. Even if you have a building that had all the same tenants and all the same income it had 3 years ago, if your debt's maturing today, you have a problem. So here's what's happening in terms of debt maturities. If you look out to 2028, 29, 30, the debt maturing in those years is roughly 200 million, 200 billion. You look at what's happening in 2023, 24, 25, 26, 27, the numbers are huge. The black part is bank debt. The red part is CMBS debt. And when all is said and done, we're talking over significantly over $1 trillion of debt that's maturing, and the whole real estate community doesn't know how this is going to play out. I think the interesting part about how this plays out is this theoretical approach. If you go back to the S&L crisis, the regulators were all about mark to market. But if you go to the great financial crisis, you never heard mark to market. It was the opposite. It was extend and pretend, right? And that is going to be telling on what happens to asset values. If the regulators let the banks extend and pretend, then what happened in the great financial crisis, a lot of workout people like me said, oh, this is a disaster. Lenders, they're going to have these zombie assets on their books. But lo and behold, if you hold it long enough, the market actually got better. And it was all worked out, by 2012, 13, 14, 15, that extend and pretend actually worked. But it worked at a time when interest rates were going down. So if the debt that was maturing during the great financial crisis was at 5%, but the current interest rate dropped to 3% or 2%, and the bank extended and either kept it at 5% or dropped it to market, it worked. In this market, interest rates have gone up dramatically. Are the regulators going to allow borrowers to extend and pretend at the old interest rate, or are they going to require the new interest rate? Are they going to require marking to market and bringing loan to value ratios into compliance with standards? So that gets us to the end. So I think, Marty, I'm good on time.
We have all the questions.
Yeah.
So, what are the implications for municipal governments and state governments on real estate taxes? If the Sheraton goes from 600 million, 300 million.
Yeah, you figured it out.
What does that do to New York City property taxes?
What does this do to every city's
Yeah.
real estate tax base? I think it kills it. I mean, it kills it. Every commercial property owner, by definition, every year files a cert petition and tries to challenge its taxes. Sometimes they win, sometimes they lose.
But now you've got the
But now
data.
in this environment, the data is horrible. Right.
Question. In terms of regional geographic, you see any, like in the south, do you see any cities that are doing better with commercial real estate or any specific?
Yeah, my question is gonna be, is there a small economy versus the rest of the country sort of story to tell?
There are definitely markets that are hot, right? People talk about Austin, people talk about Nashville, people talk about the Southern Florida markets. But this valuation issue doesn't change. Like interest rates are the same across the country, right? There may be markets where people are prepared to pay more because they just want to be there. Prices being paid for real estate in Miami are through the roof. In West Palm Beach are through the roof, just because people want to be there. So it may not be just those prices may not be justified by a rigorous review of the numbers, but in general, like interest rates are what they are. Cap rates have definitely changed. Value has definitely come down.
Can you take your presentation now? I just want to, well, actually, just leave it up actually, but I want to talk about a couple of things. I think it's a great presentation. It's not dramatic enough because we had a meeting. I want to see people falling off buildings. But no, the LTVs are way down, right? I mean, before you could get financing 80 to 90%.
Correct.
Now I think 50% kind of senior debt, and most people aren't giving any kind of secondary debt. You might get something called PACE loans, which are kind of taking
That's a whole different thing.
right.
Right, but to talk to your point, because that's a great point, right? If something was valued at 100, and when you bought it, you paid 100 for it, and you were able to finance it at 75%, right? Today, that property, say, is worth 80. Let's just be generous, right? And say there's a little bit of equity. It's worth 80, and you have to refinance it. You have to refinance it at 75%. Even if you were refinancing at 75%, all of a sudden, you owe an equity slug to do the refinancing. But lenders said are even more conservative. So maybe they're not refinancing at 75%, they're refinancing at 65% or 55%. So you have a bigger equity slug to make. So what's happening in the commercial real estate market is a lot of people are handing back the keys. If you were looking at that first presentation that was scrolling before I started talking, I mean, there's a lot of examples of people handing back the keys because I'm not putting $25 million into this property just so I can refinance it. Lender, it's yours. You go figure it out.
So that was my first comment was the LTVs. The second thing is that all the regional banks are trying to sell off their real estate portfolios, right? Because they're seeing what happened with First Republic and what happened with Silicon Valley Bank, and they a lot of them feel because a lot of the loans are at very low rates, they feel like they're very extremely vulnerable if there ever was mark to market.
Look, I don't.
So I'm just saying that. So that's another aspect. So you're talking about how we said it's very difficult with LTVs at 55% or more, but the other part is that people are selling their portfolios. They're just like, I don't want to have any part to do with it anymore. I know.
Yeah, I mean, I don't think that's happening. It's definitely happening. Banks always sell debt, so that's a process that goes on. How much it's happening now, I don't know the answer to. How much it's increased, I don't know the answer to. In part, it's a dangerous thing for a lender to do right now. For a regional bank, for a community bank to put its loan portfolio up for sale and have that marked down, that's what starts runs on banks, right? All of a sudden, what they had as an asset at X is now 50% of X.
So most of the commercial assets are done by the regional banks and the community banks.
Yeah, most real estate lending is regional and community banks.
So are you seeing a resurgence of private credit? And if so, in what areas?
There's a lot of private credit in the real estate world. but we'll call it smart money, right? It's nobody's throwing good money after bad. And, it's this situation of, we're going to lend at an appropriate loan to value ratio. What's an appropriate loan to value ratio? It used to be 75%. Now maybe it's 60%.
I mean, a lot of the private credit probably is in the form of bridge financing, which is short-term, high rate, right? So
Right,
people
bridge
are saying,
financing
"Hey,
is-
I don't want to have the long-term,
That's
bubble."
what mezz, right? That's what mezz said, which is back in.
I don't know who's doing mezz debt today. It's the mezz debt lenders who are foreclosing today, as opposed to putting out fresh money.
Is this idea of converting commercial real estate in New York to condo, is that realistic? I've heard some buildings thinking of that.
Oh, yeah. I mean, everyone's trying to figure out, okay, so what do we do with all these office buildings, right? There's lots of vacancy, the value has decreased. What do we do with them? It's not easy, right? We need housing. There's no doubt that every city in America needs more housing, needs less expensive housing. But making conversions of an office building is very tough. The windows are sealed. You got to open windows. The floor plates are way too big. You have too much internal space. There's no plumbing, right? I mean, think of running plumbing through a building like this, or individual bathrooms. And we're not buying condos.
Just to comment on that, Michael and I actually used to work at 30 Rockefeller Center many years ago, and friend just invited us up to lunch there, and he said, I think 6 or 7 floors of the 30 Rock building are being converted to condos or residential use. I don't know what period. Yeah. 10 Rock, and then the Waldorf Astoria. I know they went through many years of the project of converting a lot of their rooms to kind of condos and stuff in the city. So, but to your point, I think the starting price was, $3 million, something at the Waldorf, no surprise. I'm sure 30 Rock is going to be very expensive too.
Yeah, of course. Right, so you've got to start that process at a basis that's really, really low. You probably have to have lots of tax credits, and you got to think about you got zoning issues that have to be dealt with. Zoning in this city, it's it could take years.
Nothing's done fast.
Nothing is fast. Nothing is cheap.
For time value of money, that's not a good story.
That's right. That's not a good story. So something I did hear in terms of a conversion, which I thought was pretty clever, I wish it were my idea, is converting office space to life science space, because that's basically office space, but it's office space with more power, more HVAC. So clever. I think that's a lot easier to do than putting in residences.
Is there enough life science capacity to take up all that, or what is it like?
I mean, it's life science capacity
So
for
it's
the
the
next
space
100 years.
I work in. I mean, Columbia University has done a lot of what they call wet space and so on. And it's much more now than it was years ago. Just a few blocks away from here on 29th and First Avenue, we have huge Alexandria life science facilities. So a lot of success stories.
Well, yeah, and go look at Rockville, Maryland.
Yeah, so I have a
And
client in
all-
Rockville too.
Well, no, but and even Times Square, there are a lot of biotech, artificial intelligence firms which have now located to Times Square. But they still need the scientists, and you're not going to find them.
Well, I mean, I think Ken Swig said something once at one of our presentations where he said that New York has 10 times the amount of value in their office buildings as like San Francisco or other, so it might work in, Maryland or places like that, or Boston, but New York's a much different story itself.
Yeah,
So,
but if you look at Cornell right in the water here, I mean that's huge. And then the science is here though. I mean, between Mount Sinai is a few blocks away. You got NYU, you got Columbia, you got Laval, Cornell. So there's a lot of, Bloomberg really made the push to switch to diversify a little bit just from all the money from Wall Street, and did a good job. But it's not Boston, it's not North Carolina, it's not some other areas, but it's getting better.
well, Harold, listen, I think our time is up. So
Time's up.
fantastic job, really great.
Thank you.
My only suggestion, I think you need to take down your presentation at some point. So the other people, because right now it's still up.
It is.
Yeah, but my only comment is that Harold has a fantastic LinkedIn feed. That's how I found him. And I was like, hey, this is what everyone's talking about for the last 6 months. And he actually, every week, almost every day, he has something going on LinkedIn that is thought provoking about this
I've
office
got my wife's
and
name.
real estate crisis that's occurring. And I think it's, so connect to Harold on LinkedIn. And this is just a great way to start off the day and talk about where opportunities are, because I think that,
Thank you.
as you said, savings and loan was mark to market. The last crisis was extended pretend. The untold stories I know we talked about, the huge and massive funds that came into the space and did deals in the back rooms that were not highly publicized, whether it was BlackRock or people like that, Blackstone. And I think that's another story. And whether or not people want to take on the high risk of high debt, or high interest rates it's very thought provoking. So excellent. Thanks again. Thanks so much.
Thank you.